Hello, thank you for attending this webinar. The topic will be uh, real estate review 2021, actually 2020. Let's go over the past 18 to 24 months of real estate uh, activities, and then we're going to talk about what transpired during the past 24 months, how our investors did not do, and then 2022, we can talk about that. We don't have a crystal ball, but let's do some prediction beyond this year as we come to a 2021 ending. My name is Siwing Yi from the Year Real Estate Network, and my great friend and partner, Mr. Richard Advani from Supreme Lending. He is our loan agent expert for our network, and so he has, he's pretty much understand our philosophy of investing. He understands the markets that we're pursuing all these years. He himself has done many of the properties in our neck of the woods, if you will. So very exciting. Thank you, Richard Avani, for co-hosting this webinar with me, and thank you for all your precious time. I know you're very, very busy doing investment loans with investors all over the country, all 50 states, and you also do owner occupied loans as well, mainly in California, but again, everywhere else. So you have a great team. You are an important part of our team to help our investors to finance their purchases to achieve tremendous amount of wealth. So let's get to it. Let's get to it. So let's start by going over the really what's happening at the in 2020. I mean, I recall March of 2020. We talked about 18 months ago. So many things happened. So let's recap what transpired. So the pandemic happened in March of 2020, around 18 months ago. And then everybody thought, the real estate market is going to crash. Wow, are we wrong? All of us, experts, novice people, you and I, everybody was wrong. And then, as I recall, the Fed lowered the interest rate to a historical low. I remember that very vividly around the second quarter of 2020, and the real estate market just all over the country just took off. I mean, it's amazing. Then we have a shortage of homes, tremendous demands by home buyers and investors alike all over the country with a tremendous low interest rate. I mean, then, so everything just took off. Now let's go over my network. We've been promoting, Austin Metro and San Antonio for a number of years now. And then we've been promoting Central Florida and Southwest Florida and Raleigh, North Carolina, and Alabama. So those are the market that our investors have done. So in 2020 alone in Austin, I mean, in the middle of 2020, the housing prices increased 30 to 50%. That is mind-boggling. And few of our investors that, that took action, bought those rental homes at that time, like 200,000. New construction or newer built in Austin, 200K, they were getting rent for $1,750, $1,800, and they put 20% down, as well as Central Florida and Southwest Florida, and all our markets have increased in double-digit appreciation in the past 18 months, even triple-digit appreciation, and the rent and the tenant is the rental. The astronomical rental increase, I mean, is also historic. I mean, not only we seeing 20, 30% appreciation, and we also receiving double-digit rent, historical rent increase all over the country, everywhere. So that's my take. So for those of you investors that miss out, I know I can only speak on behalf of our investment group. The majority didn't take action. Few of you did, and you know who you are, and you won a lottery, really. So Richard, from your perspective, what do you take? What was your takeaway for you not only as an investment loan agent, helping many of our investors finance their properties with a historical low interest rate on an investment loan, buying multiple properties at leveraging with 20% down. But you, as a real investor, what was your take in the past 18 months that, what was your takeaway?
Well, it's just what we've always known, right? And what you and I have always been saying is non-participation in the market is the worst thing you can do. 2 years ago, right? So 2019, we were on already an 11, 10 year, a decade long upswing in real estate, right? And everyone's like, oh, it's gone up so much. It's going to cycle. It's going to drop. I'm going to hold off. I'm going to wait. And what's crazy is not only have all those people missed the boat the last 2 or 3 years, like the growth that's happened in the last 2 years has been explosive growth. And especially a lot of those same markets that people were like, no, it's too high. And, I don't know if I can support it. And, those markets in question are the Austins, the Raleigh, North Carolinas, parts of Florida, all the places that a lot of investors, myself included, thought 2 or 3 years ago that, oh, you know what, these are marginal cash flow and it's probably the highest they're ever going to be. And guess what? Those are the markets that have gone up 30, 40, 50%. I mean, I bought some outside of Austin myself 2.5 years ago for 200, 250 grand. And now they're worth 150 over that. And it's crazy. So once again, non-participation, I think or the effect of non-participation is the biggest thing I've learned. And what's happened the last 2 or 3 years has really continued to reinforce what you and I have already said for the longest time. And it takes me to the next point is people still ask me today, right? What are you doing? Are you still buying? Things have gone up so much, and they have, right? A property I bought last year at 170,000 goes for like 220 or 230 today. And that is a huge jump. And a large part of that jump is, inflation too. And inflation's not going anywhere. The cost of anything today, whether it's high inflation or low inflation, is going to be more in the future, right? Inflation is going to exist to some point or another. And right now there's hyperinflation because, as a country, of course, we printed money. So, when people ask me that, I still go back to the same logic, which is I'm not going to try and time the market. And I'm not saying the market's going to go up forever, maybe in a year or two, it'll move down a little bit, but still, if you took the logic of, oh, you know what, it could go down, I'm not going to buy, as I said, you wouldn't have participated in the last 2 or 3 years. And what I would do if house prices dropped, I'd buy more, you dollar cost average. If you adopt a philosophy of investing a set amount every year into real estate, it's the same as stocks, right? You're going to buy high, you're going to buy low, but at the end of it, it all ends up doing this in the long run. And, even people like Ray Dalio, one of the biggest hedge fund managers and one of the wealthiest stock investors out there, says don't time the market. It's the biggest thing, the biggest no-no, because no one can time the market. And we've all done it, right? We've all sold stock when we thought, okay, it's probably going to drop, and then it just shoots up, and then we rebuy after it shoots up, and then it goes down right after that. And we're like, oh, we should have stuck to our guns. Well, timing the market doesn't work. We can all get lucky here and then. But, getting off the sidelines, being an active investor is important. And it's getting harder and harder to get properties out there right now, right? A lot of people are waking up to what real estate is. And, the vast majority of the population doesn't invest in real estate, but as more and more people do, it is going to become more and more scarce. And, general economics tells us that is supply and demand, right? Prices will continue to stay steady if there's a good demand for them. And the last thing I'll say is, more than ever are we seeing how beautiful a 30-year fixed is. We take it for granted in this country. 30-year fixed do not exist anywhere else in the world. Why? Because inflation, right? How's the bank going to make money? They give you a 3.5%, 4.5% loan, but inflation's 4% a year. That's free money, right? And that's what we've seen in the last couple of years. Inflation's, I don't know what the number is. They're saying now 6%, 8%. Everyone knows what it is, right? It's 20%, 10%. Everything's so much more expensive. Rents are more expensive. And I'm sure you've heard it all over the news. They're like bracing renters for next year because they say rent inflation still hasn't caught up yet. They're projecting, I think, a 15 to 17% increase in rents across the country in the next year or two. Guess what hasn't changed the whole time? Your 30-year fixed mortgage payment has stayed the same. And That's amazing for properties you bought 3 to 5 years ago. Can you imagine 20 years from now, 25 years from now, what the inflation, how much less that dollar's worth, right? I guarantee you 20 years from now, a bar of soap's going to be 4 to 5 times what it costs today, but your mortgage is going to be the same, right? Rents are going to be dramatically higher, but your mortgage is going to remain the same. So, we're really seeing the wealth building effect of real estate through that 30-year fix, through inflation, through property values going up.
Well, Richard, I mean, you are is a happy camper. You are right in the thick of it. You are the provider of the 30-year fixed rate mortgage, and this is the benchmark for achieving wealth for real estate investors. And you and I, you know, we've been doing this Zoom broadcast for so many times, and we keep on hammering this aspect. I mean, you use the good debt, use 20 to 25% down payment on this historical low rate of investment loans to leverage one's wealth. And, I mean, we'll keep on hammering this home. It's just investors out there, you need to understand there are no other asset class in the history of the world as good as real estate because of the reasons you just discussed. A 30-year fixed rate and historical low rate, you leverage through loans to achieve your real estate wealth. This is a mind-boggling, like you said, nowhere else in the world ever before, ever could be, you can get that except Americans. We live in the US. This is an opportunity of a lifetime to get the fixed rate loan when everything is increasing in prices. The inflation, like you just said, I don't want to repeat anything else. Having said that, the few motivating investors that purchase through our network, and you know who you are, and you know what they're doing. Of course, they have the financial resources. Not everybody have money to buy so many properties, but I'm working with a handful of investors from my network who in the past 2 or 3 years, and even before the pandemic, they purchased, in Austin Metro, in a submarket, San Antonio, all around the submarket in the 100-mile radius of Central Florida and Southwest Florida and everything else. I mean, they're buying all those new builds, and the rents are increasing. Their cash flow is they get the property rented so quickly because there's so much demand for renters. We talk about remote work. People want to move into the suburbs, right? And then all this mass migration into South and Southeast, right? Texas, Florida, North Carolina, brings such a high demand for renters. And then we have tremendous low inventory. Even right now, as we speak, many markets over the country still have a mere 1 to 1.5 months of supply, whereas 6 months supply is a normal market. So some of your people, in fact, so a number of investors have purchased 7, 8, 9, 10 of the new builds, like 2 years ago, a year ago in a market for 200K, 250K. Now their properties have increased like 30 to 50% just in past 18 months. So their 200K become 350K. They bought it for 250. Now it's 400K. I mean, they are making tremendous amount of equity, and they still have cash flow. So, and for those of you that have the motivation and the resources to buy all these new builds, get the private rented so quickly that the rent is increasing exponentially as we speak. So I congratulate you and the rest of you. I'm just so sad that, like we said, just stay in the sideline. It's just it's really, really sad. Anyway, so let's move forward, Richard, into 2022. Okay, so again, you and I do not have a crystal ball. My takeaway 2022, yeah, there will be a little bit more supply inventory into the market, but not that much more. And the builders are not building quickly enough. The supply chain disruption is we all been hearing about it. It's so affecting not just the real estate industry, it's affecting the economy with the supply chain disruptions. And so we're only getting like $1 million homes, units of homes of supply moving forward. We need as a country like 4 million homes. So that disparity between demand and supply is such a big disconnect. So we're not going to talk about crash or correction. We're not going to get 30 to 50% appreciation moving forward, but I still expect house will increase because of the demands, because the millennials will regroup. Actually, I think the first quarter of 2022, that's my prediction, Richard, there will be a second wave of buyers that want to buy homes, because this past winter, in this past fourth quarter 2021, people are just tapped out. They want to take a break from all this stress, and it's a slow period a little bit. But I believe the beginning of 2022, there will be another secondary real estate boom, where there will be again, there'll be multiple offers, not 100 offers per house like we did in certain markets these past 2 years, but 5 to 10 offers per property now, and there will be bidding wars. Once again, I predict, in fact, certain organizations' website, like Goldman Sachs, for example, they predict the appreciation is going to increase at least 13% moving in 2022 and beyond. So again, moving 2022, I think the buyers will, I believe, will ready to come back to the market, but to buy, not just investors, home buyers, everybody. I know that affordability is an issue for those middle class and lower end middle class, but I believe there's another wave of real estate boom, and there will be no reduction of value, I don't think, because the demand is so high, the supply is still very, very low. So it's a moderate appreciation, we believe, but so that's my take for 2022. And interest rate, you know about interest rate, it's just my prediction. Interest rate will be, going to be a little bit higher than before, but still at a historical low rate. So, and then last podcast, we talked about the loan amount, having increased loan amount, allow more buyers to qualify for higher price homes with the mortgage loan limits that we talked about earlier. So, all right. So with that said, Richard, what is your take about, your crystal ball, if you will, for 2022 and even beyond, and talk about the interest rate, talk about the, the overall market moving forward.
Absolutely. Yeah. I mean, I think to your point, the real estate market in 2022 and beyond, at least in the short term beyond, should be pretty robust. And, a lot of people always ask me about, when the next crash is going to come, or what to do. And are we going to have another crash like we did in 2007 or 2008? And I mean, one thing you guys, or everyone, needs to understand is the fundamentals on which these loans have been made the last 10 years have been very, very strong, right? The supply and demand in the market is true supply and demand based on people that should be qualified to buy homes. What we saw before was people were getting homes with a 780 credit score in a heartbeat. That's all you needed. You didn't have to put money down. And inevitably things blew up. And, I can tell you, obviously, the industry's learned from its mistakes. And there's not this huge influx of buyers creating an artificial demand in the market that probably shouldn't qualify. So, look, if a recession happens, people are going to have tough times regardless. But is the real estate market going to crash because of that? No. There's still millions of more buyers than there are sellers of property right now. So there's a big void in it. And once again, the fundamentals on which everyone has got loans in the last 10 years and new people continue to get loans are very strong and very different than what happened on that last down cycle and last crash. So, I think the real estate market is going to remain robust for the next couple of years. And beyond that, like anything, can a correction happen at some point? Can it drop 8%, 10%? Sure. Absolutely. But obviously most of what all of us are buying are long-term as well. So ask yourself this: property values drop 10%, 15%. You still got a tenant in there. You're still making the cash flow you want. It doesn't matter, right? If it drops. Now, what if rents drop 5%, 10%? Now, most of anything that C-Wing's recommending, anything that I buy as well, has some buffer margin in there. Now, If rents drop, okay, you might not be making the cash flow that you were initially on the front end, but you're still going to cover your basis, right? You're still going to be able to weather the storm. And exit strategies are important in that regard. And I think what led to the last crash as well, people were buying properties in metro markets like California for $1 million with no money down as a rental, losing $1,000 a month on rent, but hoping they'll sell it for 200 grand more than they bought it for a year later. Well, guess what? Eventually everything crashed and all those people were stuck with these negative cash flow property, and people lost lots of money and lots of wealth. And obviously you can't buy properties like that anymore. So things are different in terms of interest rates. Rates have moved up in the last 6 months, 8 months from the lows they've had the last 2 years. But by move up, I mean, you could put 25% down a rental and still get 3.75, 3.875. So rates, and prior to the pandemic, that was about the lowest you can get a primary home, right? Rentals are still in the fours. So we're still below the prior all-time lows, so even if rates go up 0.5% into next year, so you're talking low to mid fours, that's exceptional. When I got in the business, primary homes were 6.5 to 7%, and that was 2006. So rates are still going to be overall attractive, and keep in mind, look at it long term when you're looking at this, right? It's a 30-year fixed. Cash flow numbers are getting harder and harder right now as property values go up. They're getting tighter. But you're getting a return on amortization because you're paying down the balance. So you're building wealth, right? You're getting the tax benefit of the income you are making, but also know that, 5 years, 7 years, 8 years down the line, as more inflation has taken place, rents go up, now the basis for your investment, let's say you're making $350 a month in cash flow, and that was a 8 to 10% return. Well, now when your rent goes up $250 a month or $200 a month over the next 6 years, 7 years, guess what? Now you're doubling your cash flow, and you're paying down more principal. So, I had a long conversation with a friend yesterday about wanting to invest in real estate. And the first thing that I made him aware of was that it's not a get rich overnight thing. Right? It's a long-term process. And I explained to him, like, even if you bought a multi-unit and you're making $700 a month and you bought it for 250 to 270 grand and you put $60,000 down, you're going to make a crazy good return, 10, 12%. It's amazing. But that 10 or 12%, $600 to $700 a month, right? It doesn't sound like a lot of money. But it is, it's a 12% return, but you're investing 70 grand to make that. And, you're not going to get rich overnight with $700 a month, but over the course of time, obviously, as rents increase, as you pay down the balance, as you get tax benefits, as inflation happens, and as you buy more of those, when you look back 10 years, 12 years, 15 years down the line, that's where you start creating, obviously, wealth through real estate.
Richard, great recap. Now, let me share with you just my hope for the action plan of our real estate investors within my network, or for that matter, anybody else out there. Now, for those of you, our investors that purchased those nice cash flow properties in the past 24 months since the pandemic, with 20% down, 25% down, and the appreciation, the equity is about, you gained like 10, 15, 20, 30% in the past 18 months in addition to that. So now, those investors that have 4, 5, 6 properties that they purchase in those new construction, nice cash flow homes, now they have like 70% or 60% or even 50% loan to value on their portfolio. So my suggestion is, be ambitious, be courageous. Why not cash out, refinance those rental properties and then when you do a cash out refinance, it's a tax-free situation, right? I mean, and then you use those money to buy more rental properties and put 20 to 25% down payment on those fast-growing market that we've been promoting, buying high-quality new construction. You put a tenant in there, a A-, a B+ tenant that can, you buy a property now for $350K in Raleigh or outside Austin somewhere in outskirts in a submarket in San Antonio or Southwest Florida, $350, even for $350K, 3-bedroom, 2-bath new construction home, you're renting out for like now like $2,300-$2,400. I mean, this is mind-boggling, cap rate and cash return. So, which is amazing. So, cash on refinance is a tax-free situation. You leverage your wealth, you leverage your loans to buy more properties. So you as a loan agent are in a prime position to potentially make this kind of recommendation. So, what can you add on to what I just said about the action plan moving forward for 2022 and beyond?
Well, I think everyone, I feel like a lot of new investors kind of approach real estate without a plan, and I think determining what annually you can allocate towards real estate is important, and setting that money aside. That way you set up a consistent plan to where whether it's one every year or one every 3 years, that you have a consistent plan that you stick with. That way you take out when's the best time to buy, right? The best time to buy is consistently. And, if that means buying one every 3 years, you're going to buy here, you're going to buy here, you're going to buy here, but you're going to participate in the market. And in the long term, it's called dollar cost averaging, right? It's not a new concept, but in the long term, you're going to end up buying it at the median price of what the market had to offer over that time period. So I think setting a real plan in terms of, what you can allocate. A lot of people have made a good amount of income with, or rather a good amount of gains with their stocks in the last 8 to 10 years. Obviously the market's peaked out, or rather it's the highest it's been ever. So, I think now's not a bad time to take some of those gains and invest them into real estate and utilize bonus depreciation to offset those gains, right? So you're able to cash out of some of those securities, those stock investments, with those capital gains. You're able to redeploy those capital gains, but not pay capital gain tax with bonus depreciation. And now you're buying, obviously, real estate with it. And I know Siwing, you'll attest to this too, but one of the biggest ways to build wealth too is to avoid paying taxes. And real estate's a beautiful tool to do that. So, I think setting a real plan for the first property, as well as a plan for when that second would follow, and making sacrifices to stick to that plan, are going to, put people on the action path, which, I feel like anyone who does actively buy real estate, their only regret is not buying more. I know that's mine with those couple I bought in Texas myself a couple of years ago. Looking back, I'm like, man, I should have bought 4, no matter what. Even if I had to eat a cup of noodles, I should have bought 4,
Yeah, exactly. So I'm under contract for a 4-plex, a brand new 4-plex in San Antonio. So I'm also invested in this high growth market in Austin, San Antonio market, which is poised for tremendous growth. Not just that market, but every market. As a matter of fact, we promote investment houses off market. Where investors does not have to go through the stress of the multiple listing service and participate in those very, very challenging multiple offers and bidding war situation. But having said that, all the market we're promoting right now, I mean, our market providers are having trouble finding the inventory to sell to our investors in an off-market situation, because every week, right, whenever I send out the email newsletter with a particular market with some listings, we have 2 or 3 listings per week. And the minute those listings come into my newsletter, within a couple of minutes, they're gone. So, I mean, as investors, I'm not asking or putting pressure on you to pull the trigger, but if you don't pull the trigger, those few listings that comes available in our market teams in the various market, they're gone within not only days, within hours, within minutes. So there's a lot of newbies out there. I mean, I hate to say this, you're being very challenged. You're too scared to pull the trigger. You don't have the confidence, whatever. But unfortunately, most of our experienced, savvy investors that have purchased from us previously, they are continuing to pull the trigger. Whenever we have the limited listings that comes available, they pull the trigger right away. Reserve the lot, reserve the house, pull the trigger, pay the early deposit, then do some little bit of research and due diligence for a few weeks, and then push forward, be courageous, and be fearless, and overcome fear. So having said that, so that's all I have to say. So any one last minute of parting words for investors out there, newbies or otherwise, from your perspective, Richard?
No, I mean, other than the rates are still extremely low, they're historically low. So although they've gone up a little bit, don't let that fool you, or don't let those silly low rates we had kind of jade you. There's obviously low rates projected to stay into next year. Even if they move up 0.25%, that's still historically low. Don't forget that offsets some of the fact that prices are a little high. And generally with inflation, higher interest rates can come in the future. So, get off the sidelines, go take down some properties. A lot of times you're signing property contracts for properties that are being built 4 to 6 months from now. So don't let that scare you. You lock in a price and you put your deposit down. And then when the property is 45 to 60 days from completion, that's when we'll officially get the loan started and get you squared away. Also, if you haven't refinanced your portfolio of rentals in the last 5 to 6 years, definitely reach out to us. A lot of our clients are calling in for pre-approvals, but then we're analyzing their portfolio and seeing they got properties in the high 4s and mid 5s. So, now's still a good time to get those taken care of and handled as well.
Wow, great perspective, Richard. Thank you so much for, you and I are on the same page. So thank you so much for your words of wisdom, and the rest of you out there, just focus on your action plan and take action, and over time, you will do fine financially. Thank you so much. This is Siwing Yi from the Yi Real Estate Network, and my guest speaker, Mr. Richard Advani from Supreme Lending. Thank you so much. Have a nice day.